Unlocking Financial Freedom, a deep dive into Robert Kiyosaki's wealth-building philosophy. Financial success and independence are aspirations that resonate with many. Robert Kiyosaki, a renowned financial educator, entrepreneur, and author of the best-selling book Rich Dad, Poor Dad, has offered valuable insights into how to achieve these goals. In this comprehensive exploration, we will delve into Kiyosaki's key principles for achieving financial freedom and success, providing you with a more in-depth understanding of his revolutionary ideas. Prioritizing assets over liabilities, the cornerstone of financial success. At the heart of Robert Kiyosaki's financial philosophy lies the fundamental principle of prioritizing assets over liabilities. This concept challenges conventional wisdom and offers a practical roadmap for wealth accumulation. Kiyosaki defines an asset as something that puts money in your pocket, while a liability is something that takes money out of your pocket. This perspective encourages us to view assets and liabilities not merely in terms of their intrinsic value but in the context of cash flow. Consider, for instance, the concept of homeownership. Traditionally, owning a home is often viewed as an asset. However, in Kiyosaki's paradigm, a home is not classified as an asset unless it generates rental income. Why? Because, in the absence of rental income, a home tends to be a financial liability. It consumes money in the form of mortgage payments, maintenance costs, property taxes, and more, rather than putting money into your pocket. This shift in mindset prompts us to focus on building a robust portfolio of income-generating assets. It emphasizes the importance of not just saving money but actively increasing our income streams over time. By doing so, we pave the way for substantial wealth accumulation and long-term financial security. Working to learn, shifting the paradigm. Robert Kiyosaki challenges the conventional mindset of working for money and instead encourages us to work to learn. For many, the primary objective of finding a job or pursuing a career is the promise of financial security through a stable income. However, Kiyosaki argues that this narrow focus often leads to a lack of financial literacy and ultimately confines individuals to the rat race. The concept of working to learn entails viewing each job or experience as an educational platform to acquire valuable skills, insights, and knowledge that can be leveraged for independent financial success in the future. Traditional education has its limitations, especially in teaching practical financial skills that are applicable to real-world financial challenges. While a regular job may teach you how to perform specific tasks, it rarely equips you with the knowledge of how to effectively manage, invest, or grow your money. Furthermore, it often overlooks critical areas such as understanding taxation. By working to learn, individuals can strategically choose jobs, roles, or projects that offer opportunities to acquire these essential skills. The primary goal is not immediate income but the acquisition of a skill set that can be used for future entrepreneurial or investment ventures. The significance of cash flow, a lifeline in financial freedom. Robert Kiyosaki emphasizes the critical importance of cash flow in his financial philosophy. It is not about how much money you have in total, rather, it's about how much money you have coming in regularly. Kiyosaki highlights that traditional markers of wealth, such as a high net worth, can be misleading if they are not accompanied by positive cash flow. For example, consider lottery winners who suddenly find themselves in possession of a substantial amount of money. Despite the apparent windfall, these individuals are not necessarily wealthy. They may have a significant amount of disposable cash at a given moment, but this influx of money does not guarantee long-term financial freedom. Without a consistent cash flow, they may still struggle financially. The distinction between assets and liabilities in terms of cash flow provides a practical roadmap for wealth accumulation. Assets that generate regular income streams, such as rental properties, dividend-yielding stocks, or businesses that operate independently of your day-to-day involvement, play a pivotal role in achieving financial freedom. By focusing on assets that generate positive cash flow, you are not merely storing value, you are actively increasing your income streams. Over time, These income-generating assets have the potential to compound and create substantial wealth and financial security. Understanding taxes and corporations, a strategic approach. Robert Kiyosaki often discusses the vital role that understanding taxes and corporations plays in achieving financial independence. Rather than following the mainstream approach of paying taxes first and then managing expenses with what remains, Kiyosaki suggests using the legal framework of corporations to minimize tax burdens while maximizing income and investment opportunities. Corporations offer advantages such as deducting expenses before paying taxes, which can significantly reduce your overall tax liabilities. This strategic shift involves transitioning from an employee mindset to an investor-entrepreneur mindset, altering how you earn money, how you spend it, and, crucially, how you protect it from unnecessary taxation. It is important to note that this strategy is not about evading taxes, it is about making intelligent and strategic decisions to generate and retain wealth. Understanding tax laws and leveraging the advantages offered by corporations can lead to not only a reduction in tax liability but also an encouragement to engage in economic activities that the government seeks to promote, such as investing in real estate or starting a business. In a world where the rules of money are often not taught in standard education, acquiring and sharing this knowledge becomes both a revolutionary act and a vital one for achieving financial freedom. How to use debt wisely, a tool for wealth accumulation. Robert Kiyosaki's perspective on debt diverges significantly from traditional financial wisdom. While many people see debt as something to be avoided, Kiyosaki advocates using good debt as a tool to accelerate wealth accumulation. The key lies in understanding the difference between good debt and bad debt. Bad debt is the type most people are familiar with. It involves borrowing money for purchases that depreciate in value over time, such as luxury items, vacations, or cars. This type of debt saps your financial resources and leaves you poorer in the long run. On the other hand, good debt is used to acquire assets that generate income or appreciate in value over time, such as rental properties, businesses, or investments. The income or appreciation from these assets can not only cover the cost of the debt, including interest payments, but can also generate additional income, creating a positive cash flow. Leveraging good debt wisely can amplify your investment returns, allowing you to benefit from capital growth, income, and tax advantages. However, this strategy comes with its own set of risks and requires a sound understanding of market conditions, interest rates, and your own financial situation. Therefore, education and financial literacy are critical prerequisites. Diversifying income streams, a path to financial resilience. Kiyosaki encourages diversifying income streams to include not only earned income but also passive and portfolio income. Relying solely on a single income source, such as a traditional 9-to-5 job, is not only limiting but also risky. Diversifying income streams, on the other hand, provides a safety net against the uncertainties of the job market and individual investments. Diversification involves not only having multiple streams of income but also different types of income. Your earned income, derived from your job, is typically taxed most heavily and requires the most time investment. In contrast, passive income, such as rental income from real estate, is often taxed at a lower rate and demands less ongoing effort. Portfolio income, generated from investments like stocks and bonds, can also be more tax efficient and managed with less time commitment. The key takeaway is that diversifying income is a strategy that offers both immediate benefits and long-term security while simultaneously providing various tax advantages. Don't keep money idle in the bank, the power of investing. While there is nothing inherently wrong with saving money, Robert Kiyosaki argues that relying solely on savings is an outdated model that doesn't account for the diminishing purchasing power of money due to inflation. Saving money without investing it means that the value of your savings is eroding over time, as the cost of goods and services typically rises. Kiyosaki recommends investing in assets that have the potential to outperform the interest you would earn from a traditional savings account. These assets can include the stock market, real estate, or other investment opportunities. The key is to put your money into assets that can potentially provide a much higher rate of return. However, it's essential to note that investing is not without its risks, and it requires a sound understanding of the financial landscape. Kiyosaki promotes the idea of financial education to make informed investment decisions. It's crucial to know the basics of any asset class you're investing in, understand its risk profile, and stay informed about market trends that could affect your investments. By investing wisely, you are not merely stashing money away, you are actively participating in your own financial growth and increasing your wealth over time. Don't follow the herd, make informed decisions. Robert Kiyosaki advises against following the herd mentality in financial decisions. This common behavior involves going along with what everyone else is doing, often under the influence of fear or greed. Making financial decisions based on the actions of the crowd can be incredibly risky because it's often reactionary and not rooted in rational or informed decision-making. Instead, Kiyosaki recommends doing your own research, understanding the market, and making financial choices that align with your personal goals and risk tolerance. By not following the herd, you can identify opportunities that others might overlook, such as undervalued assets or emerging industries. Avoiding herd behavior often allows you to buy assets at a lower price and sell them at a higher value, as you are not competing with the rush of buyers and sellers. Making informed decisions based on your own analysis and research can lead to more successful financial outcomes. Surround yourself with smart people, the value of social capital. Robert Kiyosaki places a significant emphasis on surrounding yourself with intelligent, knowledgeable people when it comes to financial growth and independence. Your social circle is not just a reflection of your personal life but a crucial factor that influences your financial future. By associating with individuals who possess expertise in areas you wish to excel in, you gain access to invaluable insights, advice, and opportunities that you might not have encountered otherwise. Think of it as an investment in social capital. Being in the company of financially savvy individuals exposes you to different perspectives and strategies that can enhance your financial decision-making. The people you choose to surround yourself with can either elevate your knowledge or hold you back. As Kiyosaki famously states, you are the average of the 5 people you spend most of your time with. If those individuals lack financial knowledge, it's likely to affect your own financial literacy negatively. Conversely, being among financially educated and successful peers can motivate and empower you to improve your financial acumen. Know the market, informed decision-making. One of the key aspects of Robert Kiyosaki's financial philosophy is the importance of knowing the market. He, like Warren Buffett, avoids getting involved in things he doesn't fully understand, even if they seem like great opportunities. For Kiyosaki, investing is not about blindly putting money into assets and hoping for the best, it's a calculated process that requires an in-depth understanding of market dynamics, consumer behavior, and economic indicators. To know the market effectively, you must do your due diligence before making any investment decisions. This involves understanding the past, present, and projected future of the asset you're interested in. Are you investing in a growing industry? What are the historical trends of the asset's price? What do experts in the field say about its potential? Is the market saturated with similar investment options? Understanding market cycles is also crucial. Whether it's the real estate market or the stock market, prices rise and fall due to various factors such as supply and demand, economic conditions, and geopolitical events. Recognizing these cycles can help you make more informed decisions about when to buy, hold, or sell an asset. By knowing the market, you can also identify underpriced assets and seize opportunities for higher returns. Robert Kiyosaki often emphasizes the value of financial education in identifying such opportunities. The most profitable investments are often those that the average person overlooks or misunderstands due to a lack of market knowledge. In conclusion, Robert Kiyosaki's wealth-building philosophy offers a comprehensive guide to achieving financial freedom and success. By prioritizing assets over liabilities, working to learn, understanding the importance of cash flow, leveraging good debt wisely, diversifying income streams, avoiding keeping idle money in the bank, making informed decisions, surrounding yourself with knowledgeable individuals, and knowing the market, you can take control of your financial future and build lasting wealth.